Very good evening, all of you students. My name is C.A. Divas Gupta, and today we will be discussing on the topic of risk analysis in capital budgeting. Uh, Good evening, Alok, Ganesh, Sapna, Nipun, Jyoti, Sankaran. Very good evening to all of you. So, students, let's start our topic on risk analysis in capital budgeting. So, if we see capital budgeting is all about, you know, understanding and reading about two things. One is about the cash inflows, and second is cash outflows. As you all would have studied in your previous sessions, there are different techniques to evaluate cash inflows and cash outflows in totality to evaluate whether we want to invest in a particular capex decision or not. So that part is very clear that we have already studied and got a lot of understanding. But today's session is very important because we will be building those. We will be building some other concepts using those basic things. One of them being risk analysis. So we will see how risk analysis plays an important role in the practical world of capital budgeting. Anurag, good evening. Bala Vinodi, good evening. Priyanka, good evening. Yeah. So students, if you see risk analysis, or if I focus on this term risk, so there are three terms that we need to understand in this context. Okay. First is certainty. Second is risk. And third is uncertainty. Now let us try to understand all these three terms so that our concept building happens quickly. So if we say something is certain, that means 100% it is bound to happen. There is no ambiguity that this thing will not happen. There is 100% certainty that something will happen. This can happen commercially in which all cases? If there is an agreement in place. Let's say agreement to supply goods. Right? If I have an agreement to supply goods, which already captures that at what price I have to supply and what quantity I have to supply. So this will give me a cash flow which is certain. Correct? I can just take the cash flows from those agreements and build in my capital budgeting decisions. Now, what about risk though? I think certainty is clear, right? Certainty is very simple. Now, if everything is 100% certain, that will be coming under certainty. Now, I'm just putting risk here. Now, students, I want you to think it from the perspective that under risk situation or the second situation that I have put, there are different scenarios possible. Let's say A, B, C, D, and E. I am assuming, let's say 5 scenarios are possible under the risky situation. And since we're talking about capital budgeting, I will always base my examples on cash flows, right? So I would say that under situation A, cash inflow is, let's say, 2000. Under situation B, cash flow is, let's say, 3000. If situation C happens, then cash flow will be 5000. If D happens, then it will be, let's say, 1000. Let's assume there are 4 cases. A, B, C, or D. Anyone will happen. Either A will happen, or B will happen, or C will happen, or D will happen. However, I have some statistical tool with me with which I can predict that what are the chances, or let's say what are the probability of A to happen. So with that, I come to know, okay, there are 20% chances that A will happen with a cash flow of 2000. There is a 30% chance that 3000 will happen. There is a 40% chance that 5000 will happen. And rest, there is a 10% chance that 1000 will happen. Okay, Abdul, noted. Pathasarthi, good evening. Anurag, good evening. So, as I was saying that under the risk situation, we have different kind of situations, correct? Because we don't have anything certain and we don't have anything uncertain. We have a middle, or let's say we have a in-between situation in which we can predict the different amount of cash flows with some different associated probabilities. This is the most relevant thing that we are going to study under the risk, because practically if you see, even certainty don't exist. Despite of being we have an agreement, but what if there are supply constraints? What if, let's say, agreement is not getting met out? So nothing is certain. If we talk about future projections, nothing is certain, right? So hence, this is the most used scenario in the practical life. Now let's talk about something uncertain. Now, uncertain is a situation where you can't even estimate the cash flows, neither their probabilities. No cash flows and neither their probability. Nothing can be forecasted. Hence, there is a complete uncertainty. Now, just to give all of you an example, if a company launches a new product, if there is a new product launched by the company, there is no set precedent that what is going to be the demand. We cannot foresee that what is going to be the cash flow because of those new products. Hence, there is an uncertainty in such situation, which will lead to no data available for the cash inflows and outflows for the future. Okay. Now, since our most relevant scenario is risk, I'm taking this down. So what if I try to calculate what is the best possible outcome from this? Or I can say the expected cash flow. So I'm using a term, expected cash flow. Now, in statistical terms, expected cash flow is nothing but your mean, which is average. We can call it as average or mean, which is simply multiplying the cash flows with the respective probabilities and taking a summation. So if we do that, it comes as 3,500. Okay, for example, I'm saying it comes as 3,500. So this is situation A. Within risk, I'm saying. Now situation B, I say that, okay, I calculate two statistical measures. Instead of only mean, I calculate standard deviation as well. So I would say that average cash inflow is 3,500 that we saw, but there is a risk of plus minus 500. I will come to all of these things, but please stay with me to understand so that we build the concepts from here. So in this particular situation, I have only calculated one specific measure, which is mean, and it comes out 3,500. But in situation B, I have calculated average, which is mean of 3,500. And I am also telling you one more qualitative/quantitative information, that there is a risk of plus minus 500 while you study average of 3,500. So that means on a lower end, I can expect the cash flow to go down up to 3,000. On an average, I can expect it to be 3,500. And at the higher end, I can only assume it to be 4,000. So this is plus, this is minus. This is minus 500 plus 500. And this is what we have calculated. So this gives me range. This is lower range. And this is upper range. I hope this point is clear. So don't you think that compared to situation A, I get useful information from situation B? Because apart from averages, I also know that in what brackets can I assume my cash inflows to be upside or downside. Okay, students. So Now, again, I'm relating this to the, practical life. Practically, always there is a risk associated with any kind of estimation you do. So I can say that risk is a part and parcel of any decision making. Capital budgeting, one of them, right? Because capital budgeting is what? It is helping you to make any decision. And as I told you that practically it's not very much feasible to calculate or to estimate the cash flows with 100% certainty model. There will be some element of risk which will tell you that, okay, this is the best possible thing, but keep in mind that it can go plus 500, it can go minus 500 also. Now let me see if there are any queries. Yeah, Sharon, good evening. Perfect. So students, if you have any queries, please do keep on posting. Okay. So I am writing then in statistical terms. Mean is equal to average that we just saw, right? Or we also call it as expected cash flow. Perfect. Then standard deviation, which is also represented by this sign. This is called as risk. Somewhere we also call standard deviation square, which is variance. This is also referred to as risk. Okay, I will come to this. So risk generally is standard deviation or variance, whichever way you can say. Okay, students. So, yes, Ravi, good evening. So this is our basic thing that we have to always keep in mind, that any kind of decision making which involves future cash flow estimation includes risk. And whenever we talk about risk, there is a statistical method, there is a statistical measure that we use, variance or standard deviation, because variance is the square of standard deviation, simply. So both the things can be used interchangeably. Now let's come to the techniques. There are certain techniques that are part of our curriculum that we have to study while we need to analyze the risk in any kind of decision making for capital budgeting. So the first technique is probability. Now students, probability, what is probability? Probability is chance of an event occurring. So if I say probability in very layman terms, don't be scared with this. It's just a chance of any event occurring. Correct? If I know, let's say there are only 4 possible events that can occur. So what is the different possible chance of an event occurring? In my previous example, this is probability 20, 30, 40, 10. All these percentages are probabilities. Now, can any one of you tell me what is the range of a probability? I mean, it's a very simple question. We all know that what is the range of probability? What is the maximum value of a probability that we can expect? And what is the minimum value of a probability that we can expect? Come on, students. Some of the responses, if we can expect on the question handle. We will make this session a bit interactive so that all of you are also involved. It's a very simple and easy question to all of you, that what is the minimum and maximum value? Perfect. I think all of you gave correct answer. Wait. Alok, right. Piyush, right. Vedika, right. Sapna, okay. Abdul, okay. Dhyanesh, 0 to 1. Heath, okay. Jyoti, maximum 1. Now, Parth Shastri, okay. You have to see here, because 1,000 to 5,000 is not the right range. Priyanka, fine. Shreya, Sapna, Jyoti, Sharan, everyone is right. Okay, now let me say probability is always 0 to 1. Or I can say 0% to 100% if we put percentage. Okay, in absolute terms, it is 0 to 1. And in percentage terms, it is always 0 to 100% because the maximum that a chance can happen is one time, right? We can't say it is 1.5 times. Correct. And it is always forward looking. It is always forward looking. Sharon is saying maximum infinity. No, it's not infinity. It's always one. Ajmal Khan is saying maximum 100, minimum 1. I think if you are expressing it in percentage, then you're right. Just Shah is asking, sir, I think it's mean plus SD or expected cash flow plus risk. Okay, I'll come to your question, Josh, because I will relate this example, mean and risk, how this is useful. Okay, just bear with me. But probability always, in all the cases, is 0 to 1. It can't be anything else. Now, I'll just write this formula. I think this is also given on your study material, but still, if we say that what is the expected net cash flow, we have already calculated expected net cash flow is what? Mean. For calculating mean, what we did, we just multiplied it with the respective probabilities, the respective cash flows, right? And taken a summation. So summation of I is equal to 1 to n, which is for all the observation up to n, net cash flows that are coming multiplied with their respective probabilities. Simple. Then there is also concept of expected net present value. So whenever there is a term called net present value, since our capital budgeting decision involves 5 years, 10 years, 15 years, 20 years, I mean more than 1 year as a time horizon, we always use a time value factor. And I will also tell you in my upcoming, in this session only, why there is a time value factor adjusted. Okay. But still, I think all of you know from your previous knowledge, what is net present value? If I divide by 1 plus discount rate, raised to the power number of times the years it is, it will give me the present value. Okay. So I'm just writing down that here. Summation is equal, I is equal to 1 to n. We will take summation first of all, because it is the expected net present value. Expected net cash flow divided by 1 plus discount rate, which is, I'm assuming it's t raised to the power. I am assuming k raised to the power t. Okay. Formula wise, it might look a bit difficult, but application wise, it is very easy. We will just do a quick question to understand this. So in this, we have tried to see that what is the expected net cash flow and what is the expected net present value. So we will go to question number 1. This would have already been uploaded on the portal. So all of you can refer that from the assignment. This is a risk analysis question number 1. Probabilities for net cash flows for 3 years of a project are given as follows. It is very easy, students. I'm telling you, don't get confused with the formula or the way it is written. You will be able to understand it better once you solve this question. So please be there with me while I solve this question. So it says that net cash flows for the 3 years are given as follows. Year 1, year 2, year 3. There are different cash flows given for respective years. There is different probabilities that is given. It also says calculate the expected net cash flows. It is very easy. So let's calculate the expected net cash flows. I'm just writing solution here. So we will use the same year 1, year 2, and finally year 3. Let's put cash flow here, probability here, and expected cash flow here. Similarly, cash flow, probability expected cash flow. Cash flow, probability expected cash flow. For all 3 years, let's put this. So it's 2000, then it's 4000. I'm just copying the numbers from the question, 6000 and 8000. Vedika is saying PDF is not available. Is it the case? Because I got a confirmation that it was uploaded. So students, I request you all to once check and let me know if it is not available. This is the question. Okay. So meanwhile, I'm just continuing in the interest of time. Then I'm just writing the probability 0.1, 0.2, 0.3, 0.4. So expected cash flow was what? Multiplying probability with the cash flow. So 2000 multiplied by 0.1, which is 200. Then 800, then 1800. 6000 into 0.3, 8000 into 0.4, 3200. And taking a summation gives 6000 as the expected cash flow. Similarly, year 2, the cash flows are 2000, 4000, 6000, and then 8000. Okay, PDF is not there. Okay. Okay, students, so what I'll do is I'll just quickly project the question here. If all of you can take a screenshot of this question and then continue with me. I really apologize for the question being not there because I got a confirmation that it is there. Let me check. Let me check with the. Just a second, students. I'm just trying to reach out. Nipun is saying PDF can be accessed through previous batches notes. Okay, I don't know, but what I understand is that at least this question, I have total 9 questions to be discussed today. Those should be there with you, but okay, please concentrate. So this is the question. I think it is very simple and it is also given in your study material. Maybe I can also tell you which question I am referring. So this is illustration 2. If all of you have a study material, please open your illustration 2 from there. You can refer it. Okay. So yeah, so we were in mid of this question. 0.2, 0.3, 0.4 and 0.1. We get it as 400, 1200, 2400, then 800. The total comes as 4800. Okay. Then for year 3, the cash flows given are 2000, 4000, 6000 and 8000. 0.3, 0.4, 0.2 and 0.1. If we multiply 2000 by 0.3 is 600, 4000 by 0.4 is 1600, 6000 by 0.2 is 1200, 8000 by 0.1 is 800. The total comes out as 4200. So I think the calculation is very easy for calculating the expected net cash flows, right? Now, the second part of question also asked us to calculate the net present value of the project using expected cash flow using 10% discount rate. And it also tells you that the initial investment is 10,000. It is very easy. Now, if we have calculated the expected net cash flows, I mean, for the inflows, you can just simply calculate the present value of cash inflows. How we can calculate? 6,000 is the year one. So 1 plus 10%. 4,800 is for year 2. 1 plus 10% raised to the power 2. 4,200 is for year 3. 1 plus 10% raised to the power 3. Just a second. Yeah. So this gives us present value of cash inflows as 12,573 if we solve this. And expected net present value is 12,753. Sorry. 12,573 minus 10,000. Simple. So this gives us 2,573. This is the expected net present value. So whenever we use net, that means it is netted off cash inflows and cash outflows are deducted. Then we arrive at the net present value. This is expected net present value because it is calculated using the mean, or we can say the statistical measure there. Perfect. Dhyanesh and Sapna has also said that it is illustration 2. Okay, so this is very easy and very simple. Just we have tried to calculate what is the expected net cash flows and what is the expected net present value. Simple. Okay, students. Now let me quickly move on to the next concept. So next concept I'm taking up is of variance. Now, please, all of you, I request you to please pay 100% attention. Now, students, if you see variance, I will tell you two things, okay? I'm just writing the statements, and from there on only you will be able to calculate or let's say arrive at what is the meaning of variance. So variance is deviation of estimated cash flows. Perfect, Dhyanesh. Your answer is also right. Estimated value from expected value. Now let me take all these terms and make you understand. I'll just tell you these three terms: deviation, estimated, and expected. Students, all of you just now saw what is expected. Expected is mean, right? Or I can say average. This is just now we read, correct? All of you know. Estimated. Estimated is what? All the possible options that were there. So let's say in our previous example, estimated cash flow were 2,000, 4,000, 6,000, and 8,000. So these are all estimated cash flows. Sorry. So estimated are different possible cash flows. Different possible cash flows. So using these different possible cash flows only, we arrive at expected cash flow, correct? And what is deviation? All of you know what is deviation. Deviation is difference. Using this, I'm just formulating variance is equal to, correct? Because standard deviation is given by this sign. If I put a square here, it will give me variance. Variance is equal to net cash flow minus expected net cash flow, correct? This is for the ith term raised to the power 2 multiplied by probability. And we will take a summation of I is equal to 1 to n. I'll explain. Wait. I'll explain. This formula is very easy. So students, this is the deviation. If you see the first part of the formula before this multiplication factor, this is the deviation, correct? Now, tell me students, deviation can be positive also, it can be negative also. But we have to calculate the absolute deviation, because if we just simply take the negative and positive sign, so what will happen? If there is a negative 50 deviation and there is a positive 100 deviation, we will only be left with positive 50 deviation, which will be wrong. Ideally, there is a deviation of 150. That's why this square is done in this formula. If you see the square, this is done because of that logic, to make sure that the negatives are not reduced from the overall operation. And then respective probabilities are multiplied for that particular estimated cash flows. And then finally, we take a summation. Perfect. It is very easy. We will apply this formula and you will be able to learn this. Now, students, I just want to make a simple point here. If there is a higher variance, if let's say variance calculated comes out to be very high, so it means that there is higher risk. Lower variance means lower risk. Simple. Can any one of you tell me? And this is a very smart question. You have to think it before you want to answer. What would be the unit of measurement of variance? Will it be percentage? Okay, I'll give you 2-3 options. You tell me. Will it be percentage? Will it be 0 to 1, like in case of probability? Or will it be the same unit which this net cash flow is presented? It's a very important question, because that will help all of you to think what actually variance means. So if let's say the unit of measurement of net cash flow is rupees, correct? Because we are talking about capital budgeting. Capital budgeting means cash inflows. Cash inflows are expressed in rupees. So while you calculate variance of this, what will it be? It will be rupees or what? It will be rupees, it will be percentage, which is always, it will be always in percentage, or it will be something else. So Anurag is saying percentage, Vedika is saying percentage, Pranav is saying same unit of net cash flow. Okay, I'll just wait more moment. Dhyanesh is saying same unit. Nipun is also saying same unit, here rupees. Perfect. So this will be the same unit for which the net cash flow is expressed in, which is rupees in particular case. So don't get confused. Now, why I'm saying it will be in rupees? Because as I told you that in my previous, that qualitative data that I had given you, 3,500 was mean and plus minus 500 was risk. So even I applied that plus minus 500 into 3,500 to show you 3,000, 4,000, correct? As the lower range and upper range. That means this is the variance will give you the amount that can be adjusted in the average or mean to arrive at the lower or upper range, correct? I think I got a lot of answers. Priyanka, same unit. Parth, same. Sapna, rupees. Shreyas, same. Jaspreet is saying percentage. No, it won't be percentage. Sharan is saying rupees. Dhyanesh, rupees. Perfect. Thanks a lot, everyone, for responding. Okay, students, I hope it is clear here. Now, we also just now studied standard deviation is square root of variance, correct? Or I had written it, variance is equal to standard deviation square, whichever way you can write it, just a mathematical translation. If this is the case, then the standard deviation formula will become 1 till n net cash flow minus expected net cash flow square into PI. Perfect. PI is probability here. Now, I think all of you would appreciate one more fact. Now, students, please listen to me very carefully again. Can anyone tell me, while putting this 500 in my example, why I have put plus and minus both? Why I have put plus and minus both? I'm just trying to prove it mathematically to all of you. Because once you open square root of anything, you always assume it is plus or minus. Correct? So standard deviation, I told you it is a square root of variance. So first you will calculate variance and then you do a square root. Hence, hence standard deviation will tell you that from mean it can go positive also or it can go negative also. This is a very important thing to keep in your mind. Yes, Dhyanesh is perfectly right. Square root of any number may be positive or negative. It can be positive or negative. I think Abdul, Geet, this can go both ways. Perfect. Jyoti is also saying because of square root. Perfect. Just a second, student. Yes. So Abdul, Dhyanesh, Pranav, Geet, all of you are right. And these are the kind of answers that I expect. Very nice. Perfect. Okay. I hope now your understanding is evolved at step 1. Now I am coming to step 2. Let's use this information in our capital budgeting. I think all of you are now clear what is standard deviation, what is probability, what is mean. Now I'm throwing in situation to all of you. All of you analyze this and tell me which project is better. Okay. So if I talk about project A, I told you higher risk means higher standard deviation. Lower risk means lower standard deviation, or I can say vice versa also. Lower standard deviation means lower risk. Higher standard deviation means higher risk. If I talk about project A has a risk, or let's say a standard deviation of 100, and project B has a risk or standard deviation of 120. Now, all of you, please tell me, will you select project A or project B? Or there is a third option also. You can't evaluate basis this information. You need some additional information to evaluate whether to select project A or project B. So tell me, students, option A, B, C. A is project A, B is project B, and C is you want some further information. Please type A, B, or C in your query handle. Okay, Dhyanesh is saying project A, Jyoti A, Pranav A, Parth A. Abdul saying need additional information. Sharan is saying project B. Dhyan is saying option C. Okay, Dhyan has changed. He's saying his option C because he might have given his answer earlier. Perfect. Sharan, project B definitely we will see, but as of now, so Jash is saying we can't know without risk appetite. Vedika is saying additional information. Shreya C need return. Perfect, Geet. Very nice, Geet. Geet is saying we also need to know what is the return. Only standard deviation will not help. Jaspreet is saying C. Irappa is saying A. Okay. So now most of you are saying you need additional information, and Geet has already told you that you need return. Prachi is also saying because SD is low, hence we will go with project A. But okay, till now, I think project A is the choice. If you ask me also, project A is the right choice, but it is not okay for us to conclude basis only the risk. We also need to know what is mean, which is the expected return. Correct? Mean is your expected return. This project has been of 500. This project has been of 1200. Now, students, all of you tell me whether project A or project B. Apart from this, I can tell you there is no other option. Option C is not there this time. Correct? Because we have to only stick to standard deviation and mean. Risk appetite, we are okay. We can take either project A or project B. Risk appetite allows us for both the projects. But functionally, or let's say logically, with these two information, which project would you select? Josh is saying definitely B. Piyush is saying B. Jyoti is saying B. Abdul is also saying B. Why? Because the cash flows are higher compared to this. I mean, the return is higher compared to project A, but the risk is also higher. So let's do one thing. Let's calculate coefficient of variation, which is given by what? Standard deviation by mean. Okay, let's calculate for both the cases. Vedika is saying B, Irappa is saying B, Shreya B, Ajmal Khan is only saying A, Sapna B, Sharan B. Okay. Parth B, Vedika B. I think all of you are right. So what we are going to do is we are trying to calculate that for one value of mean, what is the risk or what is the standard deviation. Here it comes as 100 by 500. Here it comes as 120 by 1200. This will give me 0.20. This will give me 0.10. Now students, from here only, please try to infer for 1 rupee of mean, or let's say for 1 rupee of return, here I have to undertake a risk of 0.2. But here for 1 rupee of return, I have to only undertake a risk of 0.10. Hence, project B is better. Okay. And with this, now you also know what is the meaning of coefficient of variation. This is what I wanted to teach all of you. What is the relevance of coefficient of variation? Because standalone mean will not help you. Standalone standard deviation will not help you. The relation between both of them, which is coefficient of variation, will help you to say whether the project between two projects, whether which project to be chosen. Okay. Now let's come to question number 2, students. Very nice. I am very much impressed with all of you, the kind of responses that all of you are giving. Now again, students, this is question number 2 as per my assignment, and this is illustration number 4 from the study material. Okay. Now this question says that calculate coefficient of variation. Now for calculating coefficient of variation, we need to calculate mean, we need to calculate standard deviation, then we can calculate coefficient of variation. Perfect. Now see the question, Dhyanesh. Now Dhyanesh is saying what is the unit of coefficient of variation? Very nice. So if you see, coefficient of variation is not having any unit. Okay. Because it is just a relationship between mean and standard deviation. That's all. If I may show you here, it is standard deviation by mean, simple. That's all. It won't it won't tell you that, it is in rupees or it is in what. It just tells you that for one value, or let's say for 1 unit of mean, what is the unit of standard deviation? That's all. Okay. Josh is saying, sir, but even if coefficient variation in project B was 0.30, then wouldn't project B give a better return, as would be worst case scenario, which is 840, which is a far better. Okay, Josh is saying that if we go by absolute return, and in this case, if coefficient variation would have been 0.3, then still project B would have been better. So I would say, Josh, definitely going by the absolute values of the return, project B would have been better. Okay. But there is a risk in risk also, because standard deviation practically is not static. You see in capital market, you see in equity, standard deviation is also changing in every second, right? So please understand, these concepts are for making you clear that what is the meaning of coefficient of variation, correct? But I would agree to your point, in case in practical scenario, standard deviation is always fixed, but standard deviation also keeps on changing. So hence I'm saying just that if today's standard deviation by mean is 0.30, which is coefficient of variation, tomorrow it can be something else, or within half an hour it can be something else. Okay. Geet is saying it is like ratio. Perfect. Dhyanish, perfect. Okay, Jash. But directionally, I agree with you, Jash. In case this is also 0.30, but still we have a higher cash flow with the worst case scenario. I agree with that directionally. Okay. Yes, I was on question number 2, which is illustration number 4. Just a second. Yes, perfect. Now we said that coefficient of variation is coefficient of variation is equal to standard deviation divided by mean. Okay. Now let's calculate for project A and project B. These are the possible cash flows, right? Possible events. Net cash flow, probability, expected cash flow. Similarly, here also we will put net cash flow, probability, and expected cash flow. Okay. So possible event is A, B, C, D, and last one is E. Then net cash flows given is 10,000, 12,000, 14,000, 16,000, and 18,000. 10%, 20%, 40%, 20%, and 10%. Now just simply multiplication for calculating the expected value. 10,000 multiplied by 10%, which is 1,000. 12,000 by 20%, which is 2,400. Then 5,600. Then 3,200. Then 1,800. So the total comes as 14,000. Okay. Then similarly for project B, we have a cash flow of 26,000, 22,000, 18,000, 14,000, and 10,000. 10%, 15%, 50%, 15%, and 10%. 2,600, 3,300, then 9,000, 2100 and 1000. The total comes as 18,000 here. So these are the two means that we have calculated. Mean, right? 14,000 and 18,000 students. Okay, right? Then we have to calculate the standard deviation. Mean is calculated. Now let's come to calculation of standard deviation. Calculation of standard deviation. Now this is A and this is B. We have A, this is the possible event. A, B, C, D, and E. So for A, the standard deviation will be calculated as, so first I'm calculating the variance. Then we will just do a square root to arrive at standard deviation, okay? So first was 10,000 minus, what was the mean? 14,000 raised to the power 2, correct? Multiplied by the probability, which is 0.10. Similarly, here it is 12,000. The second cash flow, the second possible event cash flow for project A was 12,000 minus 14,000 raised to the power 2 multiplied by 0.20. Easy and simple. Then for third, 14,000. So 14,000 minus 14,000 raised to the power 2 multiplied by 0.40. Then next one is 16,000 minus 14,000 raised to the power 2 multiplied by 0.20. Then next, 18,000 minus 14,000 raised to the power 2 multiplied by 0.10. And if we just do a total by taking a square and multiplying by the respective probabilities, I'm not writing the numbers here. I'm just taking a total which is 48 lakhs. Similarly, for project B, if we see applying the same formula, I'm just writing this for the first possible event, 26,000 minus 18,000 raised to the power 2 multiplied by 0.10. Correct? This gives us 64 lakhs. Next one is 24 lakhs. Then it is nil. 24 and 64 again. Total is 1 crore 76 lakhs. So this gives us variance. Correct? Now the standard deviation is equal to under root 48 lakhs under root 1 crore 76 lakhs. Correct, students? Dhyanesh is saying easy, Sharan is saying easy. Perfect. Now this will be plus minus 2190.89 plus minus 4195.23. Then the final step will be to calculate the coefficient of variation is equal to 2190.89 divided by mean was 14,000. This is project A. Project B was 4195.23 divided by 18,000. So here it will be 0.1565, 0.2331. This is the coefficient of variation finally. So students, if you see in this particular case, project A has a lower coefficient of variation. That means lower risk for 1 unit of mean. Okay. I'm just showing it from here. Perfect, students. Yes, Abdul is saying A is better. Janesh is also saying A is better. Perfect. Now, students, let's come to question number 3. I just want all of you to just see on the screen, as we are not going to solve this question because this question appeared in November 2020 and it is very much similar to just now what we did. And just taking you through this question, A Limited is considering two mutually exclusive projects X and Y. You have been given below the net cash flow probability distribution of each project. Project X and Y, there are two projects. So net cash flow they have given here 50, 60 and 70. And similarly, net cash flow for project Y they have given as 130, 110, 90 and the respective probabilities also. See, what they are asking is net cash flow of each project. You just need to multiply the cash flow with the respective probability and take a summation. Variance of each project. We just now calculated variance. Then in the next step, we also calculated standard deviation. And in the last step, we calculated the coefficient of variation. And then lastly, they're asking which project would you recommend? All of you can do it. Very simple, very easy, similar to what we just know in the stepwise solution that we did here. Because if you see here, first we calculated the expected, which is mean. Then second step, we calculated variance. Here we calculated variance. Then we calculated standard deviation. Then finally, we calculated coefficient of variation. So all these 4 steps, the question is asking in a different manner. Okay. Perfect. So let's go to the next part in the interest of time. Yes. Now let's come to a very interesting discussion. We are going to, so till now we have studied probability, variance, and coefficient of variation. Correct. Now let's understand what is next technique, risk adjusted discount rate. So students, if you see interest, give me all the possible reasons that why is interest charged, why interest exists, what is the reason? Abdul, that I don't know how many marks what is asked for. I don't know, it is not mentioned here. Okay. Please don't focus on marks, focus on excellence as of now. Marks, all of you will achieve because I can see all of you have a good thought process. So Dhanesh and everyone, all of you, please tell me from your, thought, why is interest charged? Why do we expect interest to someone if we lend money? Wow, very nice. I have a lot of good answers. Nipon is saying time value of money. Josh is saying time value of money. Piyush, inflation. Dhanesh, debentures. Okay, debentures is one of the form where we charge interest. But my question is that why is interest charged? Josh, cost of capital. Okay. Jyoti, due to loans taken. No. I'm not saying that. So interest is definitely on loan taken, given debenture, these all things. But what is the primary reason for interest being charged? Okay. As a return to lender, Nipun, very nice. To get the future value, what we are investing in present. Pranav, yes, very good, which is time value of money. Dhanesh, expectation of debenture holder, which is fine. There is some sort of element of expectation because of time value of money. Priyanka, very nice. So I think all of you have organized your thoughts in a proper manner. Now let me just bucket Y part of interest into two parts. Okay. One is, so Parth is saying inflation, Sharan is also saying interest gives money. Perfect. Now interest is charged for two elements. I can say broadly two elements, right? Now just hear me out. One is time value of money, as all of you rightly said. What is time value of money? I can also say this as inflation, correct? Because one basket of goods today will not be equal to 1 year after, correct? If today it is 100 rupees, definitely that is going to be 120 rupees after 1 year. So there is a 20% inflation. So there is a 20% time value of money. The money is getting eroded by 20%. The second bucket that exists, the second reason due to which interest exists is risk. Friends, till now we have been studying that what is risk, right? How is risk used? But in interest, I expect there is a time value of money because my money is getting eroded over a period of time. There is inflation. I will lose money if I keep it. The second is risk, because there is a risk that if I lend money to you, you might not be able to repay me that back, or you will not be able to service the interest component. Correct. So there is a risk of non-payment. There is a risk of delayed payment. There are n number of risks that are associated. There is a credit risk. There is a liquidity risk at the end of the borrower. So second, I can say risk. Correct. Or I can say, in the parlance of capital budgeting. Now I'm just trying to relate it to capital budgeting. Okay. In capital budgeting, we use discount rates. Correct. Now, discount rates. Now, what does this approach says? This approach of risk-adjusted discount rate says that simply if your cash flows are risky, you have to adjust your discount rate to increase the risk element. First of all, what is discount rate? Discount rate is risk-free rate plus risk premium. Correct? So let's say risk-free rate, which is generally given by the government bonds. So government bonds in a particular country, let's say, are operating at 7%. That is a risk-free rate because investing in government bond is 100% risk-free. And there is a risk premium expected of 8%. So the discount rate becomes as 15%. Or I am assuming a second scenario in which a risk premium of 4% only I am assuming. So this will give me 11%. 7 plus 4, 11. So 15 and 11, I'm now trying to compare these two. So assume that you take a present value using 15% or in scenario 2 using 11%. With which option will you get lower present value? Definitely with this option you will get lower present value, because higher the discount rate, lower the present value, right? That you would have studied in your previous sessions. In this case, you will get the higher present value. So this is the essence. You see, if there is a high amount of risk involved, so what does risk adjusted discount rate technique says? If there is a higher element of risk involved, automatically you take the higher amount in your discount rate. That will make sure that your present value becomes normalized, or let's say it becomes lower. However, if you are investing in a project in which there is less risk, So you can use a lesser discount rate, which will automatically increase your present value. This is the risk element in capital budgeting being treated here. But the biggest limitation of using this is that you have to assume that in all the years, risk premium is same. Correct? Because for year 1 also you will use 15%, year 2 also 3, 4, 5, every year you will use 15% as your discount rate. So ultimately you're assuming that 8% is the risk premium every time. So Geet, you are right, but let's try to think it from a normal economy point of view, right? Where there is some sort of inflation. Pranav, 15%, Dhyane, 15%. Yes. So lower present value will come from 15% discount rate. Okay. So one is risk adjusted discount rate. Now let's come to the second one. Certainty equivalent method. This is also very important, students. So again, to understand this, let me take help of two situations again. Situation 1, situation 2. In situation 1, I am able to project the cash flows. Okay. But there is a risk. As I told you that definitely in practical life, I cannot estimate anything with 100% certainty. There is an element of risk always. So I can say that risky cash flows is, let's say, 2 lakh rupees. This is situation number 1. But I can also predict under situation number 2 that what is the bare minimum cash flow I can get? What is the guaranteed cash flow I can get? That is, let's say, 1,50,000. So with 100% certainty, I can say that bare minimum, I will get 1,50,000 as the guaranteed cash flow. This is certainty. Going back to the first concept that we studied, certainty, risk, and uncertainty. So this is certainty that bare minimum 1,50,000, I am sure that I will get. But there is a chance that I can also get 2 lakh rupees if there is a risk. Correct? Can I say that coefficient of certainty equivalent is equal to 1,50,000 divided by 2 lakh into 100, which is, let's say, 75%. Can I say that around 75% of my estimation of the risky cash flow will result into the guaranteed cash flows? So Geet is asking, risk premium is RM minus RF. Geet, I would say, if you, I don't know whether all of you have covered capital asset pricing model, which is CAPM. Their risk premium is defined as risk from market minus risk-free rate multiplied by the beta. Okay. I hope, Geet, that answers your question. Abdul is asking, it's like surrender value of insurance. Surrender value, I mean, I don't know whether that would be right thing to relate or not, but if there is some amount of 100% guarantee available with some cash flow, that will be guaranteed cash flow. Okay. So this is given as certainty of coefficient of certainty equivalent. Now, how will it be used in our capital budgeting? So students, if you see 2 lakh, you can just simply, put it in such a manner that 1,50,000. Sorry. This is guaranteed and balance 50,000 is risky. Or I can say this is the risk premium. Risk premium in cash flow that I expect it should be there. And certainty equivalent quotient will become guaranteed divided by the risky cash flows. Or I can also say that the guaranteed cash flow will be risky cash flows multiplied by certainty equivalent. Correct? This is a very important thing to understand. Now let us draw out the differences between RadR, risk adjusted discount rate, and CE, risk adjusted discount rate, certainty equivalent. Now students, please understand this very carefully. So if there is a risk, I'm talking about RadR first. Increase the discount rate, correct? Increase discount rate, that will lead to lower NPV. This is a risky project, correct? In certainty equivalent, what will happen? You will automatically reduce the cash flow, correct? Because your certainty equivalent coefficient will be lower. So in your risky cash flows, if you multiply a lower coefficient, you will get a lower cash flow. And this will also have an impact of lower NPV. But here, as we studied that there is a limitation that there will be same risk premium for all years. But in certainty equivalent approach, there can be different coefficient of variation. Sorry, not variation, coefficient of CE, certainty equivalent method for different years. Okay, understood? And the last very important thing that I wanted to tell you. So here is the relationship. Now this is a very layman thing that I'm putting in front of all of you. This is cash flow, this is discount rate. This is discount rate and this is cash flow. Now, if you want to use RadR, the cash flows should always be risky and discount rate should always be risk adjusted. That means risk-free plus risk premium, correct? Risk-free plus risk premium. And cash flow should be risky. But in case you want to use certainty equivalent approach, I'm putting OR here, the cash flows will be guaranteed or certain. And this you can calculate how? Risky cash flows multiplied by certainty equivalent coefficient, correct? And here you will use risk-free discount rate. Simple. So I hope now risk-adjusted discount rate and certainty equivalent approach, both the things are clear. Please think it through that RADR is a simple technique that says that you have to adjust your discount rate. Simple. Don't touch your cash flows, just increase your discount rate if the project is risky. Certainty equivalent approach says that don't touch your discount rate, always take the risk-free discount rate, okay, without any risk premium. On the other hand, for cash flows, you should take the certain cash flows, which are 100% guaranteed, which are 100% certain. And to calculate that, we take the risky cash flows and multiply it by the coefficient of certainty equivalent. So students, it's 7:16 now. Let's break for 10 minutes and let's be back at 7:26. So students, welcome back. So just immediately before going to the break, we have studied about RADR and certainty equivalent approach, risk adjusted discount rate and certainty equivalent. So risk adjusted discount rate always tells you to adjust the discount rates, keep your cash flows same, and certainty equivalent tells you to adjust the cash flows and don't touch discount rate. Now let's quickly do question number 4 to understand it better. Let me tell you, number 4 is I think it is practical problem 1, if you see. Okay, as per your study material. Yes, so question number 4 says Gaurav Limited is using certainty equivalent approach in the evaluation of risky proposals. The following information regarding a new project is as follows. They have given you the expected cash flows 0, 1, 2, 3, 4, 5 and what are the expected cash flows? What is the certainty equivalent quotient? Now students, if you see, they have given you that what is the coefficient and these are the risky cash flows. Very important point to note, they are also giving you the riskless rate of interest on the government security is 6%. Determine whether the project should be accepted. So under certainty equivalent approach, we should always use risk-free rate, correct? Which is 6%. Correct, students? Which is only what it is given in the question. So let me put here. In the first year, negative 4 lakh means this is the cash outflow. Okay. So I'm putting year expected cash flow, certainty equivalent coefficient. Then after multiplying it, we will get riskless cash flows, correct? Then present value at the rate of 6%. And finally, total present value. Okay. Year 1, 0, 1, 2, 3, 4, and lastly it is 5. So in year 0, there is a negative cash flow, which is a cash outflow of 4 lakh, which has a certainty equivalent of 1. That means the riskless cash flow will still be 4 lakh only, which is 4 lakh into 1. Present value factor will also be 1. And hence the total is negative 4 lakhs for year 0. Now let's come to year 1. I'm just putting these values first in a columnar manner. 320 in year 1. Year 2 has 2,80,000. Year 3 is 260. Year 4 is 240. And year 5 is 160. Now the certainty equivalent is also given 0.80, 0.70, 0.60, 0.40 and 0.30. Now if just just to say 0.80 here means that the 80% of 3,20,000 is guaranteed cash flow. Balance is your risk element. So let's quickly multiply 0.80 into 320. We will get 2,56,000. This is the riskless cash flow, or you can say guaranteed cash flow. 0.7 multiplied by 280, which comes as 1,96,000. 0.6 multiplied by 260, next one, which comes as 1,56,000. The next one comes as 96,000. And lastly, it is 48,000. then the present value factor at the rate of 6% is 1, 0.943, 0.890, 0.840, 0.792, 0.747. Okay. Then we will have to just multiply this column and this column. So 256 multiplied by 0.943 comes as 241,408, 174,440, 131,040, 76,032, 35,856. So the total here comes as 258,776. So this is the net present value because already cash outflow of 4 lakh is deducted here. The net present value is equal to 258,776. Simple. Very easy and very simple. I hope students, this is clear. Yeah. So let's come to the next question. This question has appeared in January 2021. A project requires an initial outlay of 3 lakhs. The company uses certainty equivalent method approach to evaluate the project. The risk-free rate is 7%. Very nice. Under certainty equivalent method, we only need to know that what is the risk-free rate, and that is what the company has given to you, which is 7%. And it also tells you that what is the cash flow after tax for respective years and the associated certainty equivalent. Very similar to what we have just now saw, right? In the previous question. And for your ease, they have also given you the present value factors at the rate of 7%. So the risk analysis in capital budgeting, this is the easiest question, I think, because you just need to multiply it. And also you need to just multiply the first year with this, second year with the second year, third year with the third year, fourth, and fifth. You will get the respective amount. And then you just have to reduce 3 lakh. You will get the amount. So it is just simply multiplication, addition, and minus 3 lakh. That will give you the required numbers, right? So, but conceptually, I think all of you are very clear what needs to be done, correct? I'm not putting it, I'm not solving it. I'm just discussing so all of you can solve it. It's a very easy and it's very similar to what we've just now. So, Sharon is saying explain last 2 columns. Wait. Okay. These 2 columns Sharon is saying. So, Sharon, if you see this present value factor at the rate of 6%, how I can derive? For 0, 1, 2, 3, 4, 5, correct? 0, it will be 1 because on 0, all the factors of present value are always 1 because it is the 0th day. For first year, it will be 1 by 1 plus 6% raised to the power 1, correct? For second year, it will be 1 by 1 plus 6% raised to the power 2. Then for the third year, it will be 1 divided by 1 plus 6% raised to the power 3. Similarly, 1 by 1 plus 6% raised to the power 4. 1 divided by 1 plus 6% raised to the power 5. If you solve it in your calculator, you will get the second last column answer, this one. This, like this I haven't calculated. For 0 also, for the sake of simplicity, I'm writing 1 plus 6% raised to the power 0. 0. And all of you know, anything 1 divided by something raised to the power 0, correct, is always 1. So this, let's say 1 plus 6% raised to the power 0 is always 1, correct? That is why 0th time it is always 1. And the last column is the multiplication of riskless cash flows and this present value factor to arrive at the present value. Okay. Now, Abdul is asking, if risk-free rate is not given, what to assume? You will be given always, I mean, if the company is using certainty equivalent method, either you will be given risk-free rate directly, or you will be given some additional information basis which you can calculate the risk-free rate. For example, you would be given RADR rate and you would also be given risk premium. So you just need to take RADR minus risk premium, that will be equal to the risk-free rate. Okay. Now, next, after question number 5, let's see question number 6. This is on RADR. And let me tell you, this is practical problem 2. Okay. This is practical problem 2 as per the study material. Now, this says that following information have been retrieved from Finance Department of Corp Finance Limited relating to 3 projects, project X, Y, and Z. All 3, they have given the cash outflows. They have also given you the project life, 5 years. Annual cash inflow is 14 lakh, 840, and 6 lakhs. Sorry, they have given you the annual cash inflows. They've also given you the coefficient of variation. Now, please don't be scared with this. This is very simple. We already know. Coefficient of variation is standard deviation divided by mean. Higher coefficient variation, that means higher risk. Higher risk means higher discount rate. Simple. Okay. You are required to determine the risk-adjusted net present value of the projects, considering that the company selects the risk-adjusted rate of discount on the basis of coefficient of variation. That is what just now we have concluded, right? What are we saying? Higher coefficient of variation is equal to higher risk. Higher risk is equal to higher RADR. Simple. This is what this paragraph is also telling you. And it says you that if there's a coefficient of variation like this, then this is the discount rate and this is the present value annuity factor. Correct? Simple. Now let's start the solution. Statement showing calculation of risk-adjusted net present value. Correct? Now there are 3 projects. Project X, Y, and Z. So there is a cash outflow 4224 and 20 lakhs. Okay. Now what is the coefficient of variation? 2, 0.80, 1.60. Now, Dhyanesh is asking, if NPV comes negative, then what is the conclusion? The conclusion remains same, Dhyanesh. In your earlier sessions for capital budgeting, when NPV becomes negative, you used to conclude that it is not worth investing in the capital budgeting decision, right? The conclusion remains same here as well. If the NPV is negative, that means it is not worth investing. Okay. Now, students, please focus here. This paragraph has already indicated you that the risk adjusted rate depends on coefficient of variation. Now, what is the coefficient of variation for project X? 2. 2 is having a risk adjusted rate of 20%. So can I put like this here? RADR, risk adjusted discount rate, 20%. 0.8. 0.8 is 12%. 1.6. 1.6 is 16%. Then I also know that what is the annual cash flow. Annual cash flows are 14 lakh, 840 and 6 lakhs. Then using this same table, we can calculate the present value. We already are given the present value factor 1 to 5 years, right? Present value 1 to 5 years. This is how much? For 20%, it is 2.990. Please note, student, this is the cumulative factor. 2.990 is the cumulative factor for year 1 to 5. Okay. So that means if for 5 years, if you keep on getting 14 lakh, 14 lakh, 14 lakh, 14 lakh, 14 lakh for 5 years, you just need to multiply it by 2.990 one time 14 lakh to arrive at the present value of all the 5 years. Okay. Then next one is 12%. So 12% is 3.604. 6 lakhs, 16%. 16% has a present value factor of 3.274. So the discounted cash flows are how much? So 14 lakh into 2.990. 41,86,000. 840 into 3.604. That is 30,27,360. Then next one, 6 lakhs into 3.274. 196,4400. So the next step is to calculate the NPV. Right? So the NPV for X, Y, and Z. So X, it is 42 lakhs is the cash outflow minus what is the inflow? This much. So net, there is a 14,000 negative NPV, right? This is NPV. The next one is 24 lakhs is the cash outflow minus inflow is how much? 30. 27, 360. I'm just reversing the sign here, students. Please note, although plus 42 minus 4186 should be plus 14, but since I have to show NPV as negative, hence I'm putting here. So for the clarification, you can show like this also. I mean 42 lakhs after the minus sign and 4186 before minus sign. Okay. Both the approaches are right only. 627. 360. This is the positive NPV, right? Because your cash inflows are higher, cash outflows are lesser. Then next one, 20 lakhs minus 6440 is equal to 35,600 minus 35,600. So definitely these two NPVs are negative. We will select the positive NPV, which is project Y. Okay, students? Yes, Abdul is saying project Y is favorable. Perfect. Then let's come to the next question. Question number 7. So this question number 7 is actually question number 3 of the practice questions. Okay. Now this is also very good question on certainty equivalent and RadR both, but a small one. So let's attempt this one. So this says that the textile manufacturing company is considering one of two mutually exclusive proposals, Project M and Project N, which require cash outflow of 850 and 825 respectively. The CE approach is used in incorporating risk in capital budgeting decision. So they are very clear that they use capital certainty equivalent approach in capital budgeting decision. The current yield on government bonds is 6%. So which is the risk-free rate? 6%. They have already given you. And this is used as a risk-free rate. That also they are clarifying. The expected net cash flows and their certainty equivalent are as follows. They have also given you 1, 2, 3, the respective cash flow certainty equivalent for both Project M and Project N respectively. They have also given you the present value factor of rupee 1 discounted at 6% for the different years are as this. 0.943, 0.890, and 0.840. They're asking you a very simple question. Which project should be accepted? Simple. Multiplication, addition, and again multiplication. These are very, simple methods. So let's evaluate Project M. Project M has 3 years, 1, 2, 3. First year, 4,50,000. Second year, 5 lakh. Third year, 5 lakh. What is the certainty equivalent? 0.80, 0.70, 0.50. What is the present value factor? 0.943 for first year, 0.890 for second year, 0.840 for third year. Simple. You just take the total. I'm not putting the multiplication, the result of the multiplication. I'm just putting the total here. The summation of all these three will come as 860, 980 less cash outflow. 8,50,000 is the cash outflow. So the net amount comes as 10,980, which is the NPV. Okay, students, very easy, very simple. Project M. It's not required. So Abdul is asking, do we need to take the double check on the PV factor given in the question? No, not required. Simply go with what it is there. Don't assume that there are mistakes in the question paper. Don't assume, because if it is a mistake, if it is for all of you, right? It's not only for one of you. So, and again, I'm saying that don't assume that there is going to be a mistake. Okay. So there is no need to cross check the present value factor. Use the same numbers that are given as is. Because the expectation from the examiner is to reduce your time. So the expectation of examiner is not to check on your, calculation of present value factor, but to check on other aspects in the question. Correct? So project M is done, then project N. Project N, similarly, year 1, 2, 3. Respective cash flows needs to be put 450, 450, 5 lakhs. What is the certainty equivalent? 0.90, 0.80, 0.70. Present value factors 0.943, 0.890, 0.840. Correct? So we have multiplied for project N basis the respective probabilities, basis the respective certainty equivalent coefficient and multiplied them with the present value factors. So the amount comes as 996,315 less cash outflow 825. Amount is 171315. Perfect. So in this particular case, project N should be accepted. Because it is giving you the higher NPV. Now let's go to the second part of the question. That is really very important. Now it is asking you that if the risk adjusted discount rate method is used, they are saying that you have solved with certainty equivalent, that's fine. But now tell us, if we use a risk adjusted discount rate method, then identify which project would be appraised with a higher rate and why. Very important thing. So they're trying to ask you that which project would be evaluated with higher interest rate, with higher discount rate simply. So from our initial concepts of RadR, we know that the project which have higher risk are evaluated on a higher rate. However, the projects having the lower certainty equivalent coefficient will indicate that in those projects the risks are higher, correct? Then only your certainty equivalent coefficient would be lower. If you think it through, if your certainty equivalent quotient is 80% or 90%, then the higher risk is there for the 80% projects, 80% certainty equivalent coefficient. Why? Because lower certainty equivalent coefficient means that you have to lower down your cash inflows to a much higher extent, correct? Project with lower certainty equivalent would be evaluated using higher discount rate, as it implies higher risk. So in this particular case, project M is risky or project N is risky? All of you, please answer. I have told you the principle. The principle is lower certainty equivalent means higher risk. So tell me whether project M is risky or project N is risky compared to each other. I hope the understanding is clear till now. If all of you can help me with the question that whether project M is risky or project N is risky. Atul is saying M. Dhanesh is saying N is risky. Okay. Pranav is saying M. Piyush is also saying M. So, okay. So Dhanesh and everyone else who is thinking that N is risky, the reason why N is not risky is, as I told you, having a higher certainty equivalent quotient means that your project is less risky. Correct? Jyoti is also saying N is risky. No, N is not risky. Okay, let me tell you this mathematically. So what we studied is certainty equivalent coefficient is what? Guaranteed cash flow divided by risky cash flows. Correct? So certainty equivalent coefficient has an inverse relationship with risky cash flows, correct? So if certainty equivalent coefficient is higher, in other words, I'm saying now is higher, then risk would always be lesser because there is an inverse relationship, correct? Similarly, if certainty equivalent is lesser, then risk would be higher. I hope it is clear. And also to tell you that if certainty equivalent quotient is lower, that means your cash flow would be very less. The cash inflows would be very less. And hence your resultant NPV would always be lower. That means your risk is high in that particular case. Okay. So project M would be using a higher discount rate under RadR. Okay. Path is saying clear. Okay. Now let's go to the last two techniques. Janesh is also saying clear. Perfect, Janesh. Sorry. Yes. So now let's come to the last two techniques. Okay. Just a second. Yeah. Perfect. So other techniques. We are left with two more techniques to study. One is sensitivity analysis. This is very important and very easy to understand also. And let me tell you, this is not only from the parlance of capital budgeting, but from a lot of things in practical life. It is even there if you will see in your CA final, it is also there in reporting, the financial reporting. Because if you see any annual report there, we need to present what is the sensitivity analysis on account of discount rate, on account of all other things, right? So sensitivity analysis is how sensitive your output is compared to your input in a very layman terms. Now coming back to capital budgeting, what is capital budgeting? Sorry. So capital budgeting is, I can say, is a model, right? It's a mathematical model in which you have different sets of inputs. What are those inputs? Cash inflows, cash outflows, discount rate, time period. So these are some different sets of inputs that goes into this model, and the output is NPV, right? This is a plain vanilla model, correct? There are other techniques also in capital budgeting that gives you to calculate how to calculate IRR, correct? How to calculate project payback period. I'm not talking about those all things. I'm just talking about the plain vanilla capital budgeting model where these are the set of inputs and they help us in arriving at the NPV, the net present value. Now, the sensitivity analysis tells you that if any one of these inputs, cash inflow, cash outflow, discount rate, time period, if any one of these four input changes or any other input also, if something else also goes, if some percentage of these inputs changes, what is the percentage change in NPV, or which is the output? So change in input, what it will lead to change in output. Why it is important? Why are we going to study this? Because as we told you that all these are estimates, cash inflows, cash outflows, all these are estimates. We can always estimate and calculate what is there today, but we also need to see that what if cash inflow change by 10%, cash outflow also changes by 10%, then what is the impact of NPV that is coming? Whether as per the current calculation, it is positive, but what if cash inflows goes down by 10%, then NPV will be negative. So all these questions are answered by the sensitivity analysis. And we try to see that NPV is most sensitive to what? Is it most sensitive to cash inflows? Is it most sensitive to cash outflows? Is it most sensitive to discount rate or time period? Okay. Let's do this question number 8, which is illustration number 10, to understand better the sensitivity analysis. This is illustration number 10 of the study material. From the following details relating to a project, analyze the sensitivity of the project to the changes in initial project cost. This is the one. This is the first one. Annual cash inflows. This is the second factor. And third is the cost of capital. Cash outflow, cash inflow, and discount rate. All three, they are asking us to calculate the sensitivity of the project. They have given you the base amounts. So initial project cost is 120, annual cash inflow is 45, project life is 4 years, and cost of capital is 10%. Identify which one of the three factors the project is most sensitive if the variable is adversely affected by 10%. So they are trying to say is, what they are trying to say is that if all these three variables, initial project cost, annual cash inflow, and cost of capital, are adversely affected by 10%. Now, what is adverse impact? When will initial project cost adversely impact? If it will increase, because cash outflow it increase, it will adversely impact the NPV. So it will increase. What about this 45,000? 45,000 is your annual cash inflow. How this annual cash inflow will have a adverse impact on NPV if it decreases, correct? Because lower cash inflow will mean lower NPV, correct? So that means there is an adverse impact if the annual cash inflow is lower. And lastly, this 10%, how this will negatively adversely impact the NPV if it increases, because higher discount rate means lower NPV. Okay, students. So now, so we have three scenarios: increase, decrease, increase. And then lastly, there is a base case scenario also. Base case means that as of now, what is the NPV, which will help us in comparing. So I'm putting here base. I'm putting here cash inflow 10% change, cash outflow 10% change, discount rate 10% change. So these are the four cases: 1, 2, 3, and 4. Now, in all the cases, first of all, what we have to do is we have to calculate the present value of cash inflows. In base case, it will be how much? 45,000 multiplied by the annuity factor for 10% is 3.169. Please note, in base case, I will not change any variable. I will take the same numbers as is. Okay. Then we will have to reduce the project cost. Project cost is how much? 1,20,000. Okay. So this gives us as 22,605. This is the base case. Now the cash inflow, how it will impact adversely if it gets decreased, right? So what we will do, 45,000 multiplied by 1 minus 10%, which is 90%. So 45,000 is reduced by 10% of 45,000. And in this, we will multiply the existing exchange rate. The rest all things will be same. Correct? Because one factor at a time we are going to change. 8344.50. Now the next one, if cash outflow is increased by 10%, the rest all factors will be same then, right? So 45,000 into 3.169 will remain same. Now this will be 1,20,000 multiplied by 1.10. Correct? This we have to increase by 10%. That will give us 10,605. The last case is the higher discount rate. So 45,000, if the discount rate is increased by 10% plus 10% of 10%, which will give us 11%, correct? 10% increased by 10% of 10% will give us 11%. So which is 3.103 minus 1,20,000. If we do this, the amount comes as 19,635. So this is the NPV in all four cases. Now let us calculate the percentage change from base case. Correct? So in this particular case, the percentage change is 22,605 has become 83,44.50 divided by 22,605, correct? Into 100. That gives us 63.08%. For this, I am putting here 22,605 minus 10,605 divided by 22,605 into 100. So this gives us 53.08%. And in this particular case, I am putting it here 22,605 minus 19,635 divided by 22,605 multiplied by 100. So this gives us as 13.14%. Now, students, please note that in case all the variables are changed by 10%. So first, cash inflows are changed by 10%, cash outflows are changed by 10%, discount rate is changed by 10%. The highest impact on NPV is given by 10% change in cash inflows. So this factor is most sensitive to the NPVs. Correct? So we can actually see it from this table: cash inflow, cash outflow, and discount rate. So all of them have changed by 10%, correct? Percentage change in inputs, percentage change in output, 63.08%. 53.08%, and last one is 13.14%. So this is most sensitive, correct? Perfect. So Abdul 8344, 10605 and 19635 all is right. Janesh is asking 10605 how it came. Just a second. 45,000 into 3.169, that is the present value of cash inflow, and 1,20,000 multiplied by 1.1, which is 132. That is the cash outflow. So if we reduce it, it comes as 10605. Ganesh, I hope if you solve this, you will get the same number, 10605. Abdul, you are right, 53 and 13.14%. Sharan is asking to explain the last two columns. Okay. So this is the last two column. In the last two column, what I've done is I have assumed that, see, because in sensitivity analysis, you always need to change only one variable at a time. Okay. You can't change all the variables by 10% because otherwise you will not know the impact at all. So in this case, I have assumed that cash outflow will have an adverse impact on NPV. That means cash outflow would be increased by 10%. Hence, I have taken into 1.1, 1 plus 10%, correct? The last column tells about discount rate. So if discount rate is increased by 10%, which is 10% is increased by 10% of 10%, then 11% should be the right discount rate. And basis that, the amount that comes out is 19635. If all will change, then NPV will be negative. Yes. But we will not be able to arrive at what is the sensitivity factor, correct? Now, coming to the next part. Scenario analysis. This is the last part. Now, what is scenario analysis? I think in this discussion only, we have arrived what is scenario analysis. Scenario analysis is, so in sensitivity analysis, we have touched only one factor at a time, correct? So scenario analysis will give us different scenarios. Okay. Let's say this is set of inputs. One, set of inputs, two. In this, all the inputs will be changed at once because all those set of inputs are one scenario. Correct? In this, one input will not change at one time. All the inputs will change as a set, as a scenario. Okay. So scenario analysis is very simple. So let's say question will say you that in scenario one, cash inflow, cash outflow, discount rate is XYZ. In scenario two, the cash inflow, cash outflow, and discount rate is ABC. Okay. Then you have to compare and calculate which scenario is better. This is very easy. It just, very much question dependent. There is no concept to understand here. Okay. Let us see this question number 9. So this question number 9 is very important. And this is actually illustration number 11. And very good question. So please again focus. TNR Limited is considering a project with the following cash flows. Years 0, 1, 2, 3. Now, if you see in this project, there are three elements. One is cost of plant, running cost, and savings. So running cost is also a cost only, correct? And savings is kind of saving, but the net savings will be 12 crore minus 4 crore, which is 8 crore. 14 minus 5, which is 9. 11 minus 6, which is 5. Okay. Clear? And cash outflow is 12 crore. Now it says that the cost of capital is 12%. Okay. The discount rate is 12%. Measure the sensitivity of the project to the changes in the level of plant cost, running cost, and savings. So plant cost, running cost, and savings, only at these three levels, they want the sensitivity analysis to be done. And they've also mentioned it very categorically in brackets that considering each factor at a time. So only one change at a time. Okay, which is similar to just question number 8 just now we saw. But they have not given you that each factor should be changed by 10%, 5%, 20%. No, this time they are saying that such that the NPV becomes 0. So you have to change the factor in such a way that your NPV becomes 0. For example, NPV is coming as positive 1 lakh rupees. So cost of the plant should be increased by 1 lakh rupees to make NPV 0, correct? That is the simple equation, correct? PV factor of 12% they have also given you. Okay. Determine the factor which is the most sensitive. And lastly, they are asking us to calculate the most sensitive factor. So let's calculate, first of all, the base, or let's say the, as of now, calculation of NPV. Calculation of base NPV. First of all, we have to do that, correct? Because without having the base NPV, how we will be able to make NPV 0 with the changes in inputs? So year 0, 1, 2, and 3. So cost of plant is how much? 12 crore, correct? As a outflow. Running cost, year 0 it is nil, then it is 4 crore, then it is 5 crore, then it is 6 crore. Savings, year 0 it is 0, 12 crore in year 1, 14 crore in year 2, and 11 crore in year 3. Net cash flows, negative 12 crore, positive 8 crores, 12 crore minus 4 crore, 14 crore minus 5 crore is positive 9 crore, 11 minus 6 is 5 crores, positive. Correct? Then present value factor. This will be 1, 0.892. This is also given in the question. 0.797 and lastly 0.711. Correct, students? I hope this is understood. So the NPV will be 12 crore into 1, 12 crore only with a negative sign. 8 crore into 8 crore into 0.892, which will be 71. 7 crore 13 lakh 60,000. Then 7 crore 17 lakh 30,000. Then 3 crore 55 lakh 50,000. Okay. And hence NPV comes as, if we just take the total and remember to reduce this 12 crore, it comes as 5 crore 86 lakhs 40,000. Correct? Clear? Perfect. Sharan, you're right. Abdul, you are also right. Thanks for answering. Now, students, this is our base case NPV. Now, what is the requirement of question? The requirement of question is to do a sensitivity analysis in such a way that NPV becomes 0. And you have to change 3 factors: cash outflow, sorry, the plant cost, running cost, and savings. Correct? So first, let's take the easy one. Plant cost. So we have very easy answer. Plant cost needs to be increased by 5 crore 86 lakh 40,000 to make NPV 0. Correct? Currently, the plant cost is 12 crore. The plant cost has to go up so that NPV becomes 0. This is a no-brainer. Plant cost to be increased by 5 crore 86 lakh 40,000 to make NPV as 0. Correct? So the percentage change is how much? Percentage change in plant cost is how much? 5 crore 86 lakh 40,000 divided by 12 crore. Correct? In 200, because 12 crore was the original cost. And that 12 crore has to be increased by 5 crore 86,000. That means we have to increase by 48.87%. Now the second one, if there is a requirement to increase the running cost, so by how much percentage the running cost should be increased so that the NPV becomes 0. That means the present value. First of all, we have to take the present value. Present value of running cost, how we can take? 4 crore is the first year number, right? 0.892 plus 5 crore is the second year number of running cost multiplied by the factor of second year is 0.797 plus 6 crore into 0.711 into 100. Now this has to be increased, right? If we see the denominator here, this is the present value of running cost. This has to be increased by 5 crore 86 lakh 40,000 so that the NPV becomes 0. Correct? So on a present value basis, the running cost has to be increased by 49.61%. Simple. Correct? Then applying the same logic to savings. Now savings has to go down actually, correct? Then only your NPV will become 0. So 586 40,000. The formula remains same. By this much, the savings has to go down 5 crore 86 lakh 40,000. But what is the present value equivalent of this? 0.892 plus 14 crore into 0.797 plus 11 crore into 0.711, which will give us 19.75%. So savings has to go down by 19.75% to make NPV as 0. Now just to summarize, plant cost, running cost, and lastly savings plant cost has to go up by 48.87%. Running cost also has to go up by 49.61%. Savings has to come down by 19.75%. Correct? To make NPV as 0 in all the three cases. Correct? So Jyoti is asking how NPV will become 0 by increasing the plant cost. Jyoti, now if you see in this example, or let's say in this calculation, instead of 12 crore, if you put it as, I'm just putting it so that I can rub it later. If I take it as, let's say 17 crore, 86,000, 17 crore, 86 lakh, 40,000, correct? If I take this number here, instead of 12 crore, then you do the calculation, it will become 0. Okay. Yes, Abdul, you are right. 48, 49, and 19.75%. Your answers are correct. Okay. Sharon is asking, sir, why are we not taking net cash flow? No. We are not taking net cash flow because, Sharon, in the question itself, they are asking that running cost is a separate factor. See, they are saying that you have to arrive at the sensitivity at the levels of plant cost, running cost, and savings. Hence, we are not taking net cash flow. We are taking running cost at one time, savings at one time, and plant cost at other time. Okay. Now, students, now this is my last question for today. If you answer it correct, I will also be happy. You all will also be happy. Correct. But if you answer it wrong, that means there is a scope of improvement within me also and within all of you also. Because then that means that I have to be more expressive. Correct. Now, my question is, out of these three things, now please, before answering, please take your time, think, and then tell me, out of plant cost, running cost, or savings, which factor is most sensitive to NPV? This is a very simple question, but there is a twist here. Now, Dhyanesh, that is what my question is. You guys tell me that which factor is most sensitive, whether it is plant cost, running cost, or savings. You have all the analysis in front of you. Plant cost should be increased by 48 by 0.87. Running cost should be increased by 49.61%. And savings should be increased by 90, should be decreased by 19.75 to make NPV 0, one factor at a time. Wow. Please think and then tell, okay? Don't see it from your study material, please. Because I am here to develop some kind of thought process in all of you. I want all of you to answer till now who has been participated in the class. Wow, very nice. Okay, let me read out. So Jyoti is saying running cost. Abdul is saying savings. Sapna is saying savings. Ankit is saying running cost. Piyush Chaurasia is saying savings. Pranav savings. Abdul is further explaining why it is savings. And Parth is saying savings. Dhyanesh is saying running. Prachi is saying sir savings. Okay. Perfect. Thanks all of you for answering. I think 90% of you are right. It is savings. I'll tell you why. Because only 19.75% will bring NPV as 0. Here we are not looking it from the I mean, the same angle in which we were looking in the previous question, right? In the previous question, we were checking the percentage change in output. Here we are calculating the percentage change in input. So don't you think only 19.75% of the change in savings is bringing NPV 0, whereas running cost has to increase by almost 50% to make NPV as 0. Correct? So Dhyanesh, that is what I'm trying to explain. Sharan, saving should be increased compared to running and plant. No. Saving should be decreased to make NPV 0 because currently the proposal is NPV positive. Correct? So once you have to make the NPV as 0, you have to reduce down the savings. So the logic of this is running cost almost, let's say running cost is 100 rupees. Okay, savings is, let's say, 50 rupees. For the simplicity, I'm saying it is 50% and 20%. Instead of 19.75, I'm taking this as 20 and I'm taking this as 50%. So your running cost has to increase up to 150, which is a 50% change to make your NPV 0. However, only a 20% change in savings can bring down the NPV as 0, which is, let's say, only 10 rupees. 20% of 50 is 10 rupees, which is, let's say, 40 rupees. Correct? 50 minus 10 is 40. Yeah. So this is a smaller change compared to this bigger change. Correct? 20% is smaller compared to 50%, right? So hence savings is the most sensitive factor. Okay, I leave you, all of you, with this thought today. Thanks a lot, everyone, for your name. Yes, Abdul, 150 and 40. Thank you. Thanks a lot, everyone, for connecting in. I hope all of you have gained something. We will again meet in our next session on dividend decisions. Till then, please revise these all concepts. And yeah, thank you. Good night. Take care. Session.